We're going to dive right now into some of the top stories that made headlines. Joining me is Tunde Abidoye, Head of Research at FBN Quest Merchant Bank. Thanks for joining me this morning, Tunde.
Good morning, Rolaka. Thanks for having me on the show.
Great to have you. So the first story I wanted to talk about was the recently released figures published by the Debt Management Office that the total debt stock increased by 11% quarter on quarter and I think 23% year on year. So the picture is still upwards. What does this mean? I mean, it doesn't strike me that these are significant increases in the debt stock, or what do you reckon? Given where Nigeria is anyway.
Well, they are significant. I mean, when you look at the domestic debt stock, it was up 20% quarter on quarter to about 30.2 trillion naira. Total public debt stock, increased to about 46 trillion naira. But again, we must remember that these debt figures don't include the ways and means advances that are to be securitized, and that's 22.7 trillion naira. Now, if we include those figures, the domestic debt will rise to about 53 trillion, and we will also have to include the 46 billion.
Why haven't we included the ways and means? Because it was approved by Senate.
Yes.
So it's within the domestic context. So I don't understand the calculations there.
Well, they were supposed to be securitized, and according to the Debt Management Office, they'll be included in the Q2 data. So we'll see them going forward. So by the time you look at the total debt, we might see total debt rising to about 85 trillion naira by the end of Q2, and that will mean about 37% of 2023 GDP. The implication of this is that we have very little headroom for more borrowing. As you know, the debt ceiling is about 40% set by the DMO, and if you have about 38% of GDP, it means you have just about 2-3% headroom for more borrowing. So that's one major implication. The second implication is the implication on debt service cost, which is rising. The Q1 data, released by the DMO showed that total debt service costs increased by about 31% year on year, but to about 874 billion naira. Last year, the debt service to revenue ratio based on CBN numbers was about 112%. You have varying numbers. The World Bank says about 96%, some other numbers about 90%. But broadly speaking, the thing is debt service to revenue ratio is very high, and it needs to come down. So these two things mean that for 2023, we might see debt service to revenue ratio approaching 80%.
Yeah, I mean 80%. I mean it doesn't even sound sustainable at all. But we're also seeing that FGN bonds, treasury bills are accounting for kind of a large share of that issuance to try and plug the fiscal gap. But we've always talked about the fact that we also need to be looking at how we boost our revenues. And I also saw recently there was the figures published showing that our revenues had actually declined month on month from the previous month. So clearly we're not doing too well in terms of trying to manage our fiscal headwinds right now.
We're not doing too well, but I would say that the new administration has started taking steps, and one of those steps was the removal of fuel subsidies, which should result in significant savings going forward, and that will ease the fiscal space a bit. There are also steps such as implementing VAT taxes on diesel, implementing VAT taxes on the informal sector, trying to get more people into the tax net. There are quite a few steps. I think more steps need to be taken. For instance, the government could do more asset sales, of moribund state-owned assets. I think we'll see more of this going forward.
And of course, we saw, you mentioned full subsidies. We saw the statement by the World Bank that the country could save about $28 billion from removing subsidies. Do you think that's a fair estimate, or do you think the savings could potentially even be larger?
Well, if you base it on the old numbers, we were doing roughly about $15 billion, so potentially it could be larger. But
$15 billion of subsidy payments,
yes. So potentially it could be larger, but I mean, it's a fair estimate, I would say, overall. So that would help. I think the most important thing is how the government applies these savings towards, boosting infrastructure and, just improving the social welfare of citizens. Yeah, I think that's the most important thing going forward.
And we often talk about the quality of spending,
yes.
From our savings in terms of, we've been getting interesting signaling from the government because you alluded to some of the taxes like VAT, but we saw yesterday that there was a deferment of the Finance Act 2023.
Yes.
So if you were taking a reading of all those moves, what would you say the government is trying to achieve? It's trying to balance between ensuring that it has a wide tax net, can bring more people into the tax bracket, but also create a conducive business environment, right? I mean, how will we achieve our fiscal goals of fiscal stability by deferring the Finance Act? Never mind that it's actually a good move for the business environment.
Well, overall, I think the government is trying to be careful. Like you said, they're trying to balance things up. Yes, you want to raise revenues, but at the same time, you don't want to overburden the people. Before now, the manufacturers were complaining about some of these taxes, the excise taxes. A lot of those taxes were very controversial. So I think the government wanted to calm things down and just try to ease the burden of, manufacturers and, people overall.
So, as part of this World Bank prediction about how much we would save from removing gasoline subsidies, it also talked about that the budget shortfall would narrow to 3.9% of GDP by 2025, which for me strikes me as a good trajectory. Are there any other broader, in your view, macroeconomic measures that could be taken to sort of narrow the shortfall or the deficit in the budget?
Yeah, I mean, one of the basic implications we'll see is that just given all the steps that have been taken so far, we're likely to see some kind of implication on the balance of payments.
Okay.
Based on the new exchange rates, if the imports level stay the same, we're likely to see the balance of payments kind of improve a bit. So that's one major aspect that we'll see going forward. Yes.
Yeah, interesting times for Nigeria's economy. Let's move over now to North America, the US. Tesla, sales of vehicles. I don't know if you're a Tesla fan or electric vehicle fan, but what do you make of the reports on the sales of Tesla vehicles? What are your thoughts? Yeah,
Tesla has had a very good Q2 in terms of delivery. So we understand that vehicle deliveries were up about 10% quarter on quarter to 466,000 vehicles. On a year-on-year basis, it's even more impressive, 83% year-on-year.
83% is massive.
Yeah, that's massive.
Yeah.
So, I mean, it's record sales. But the thing is, they've been doing this, through price cuts. The climate is becoming increasingly competitive, especially in China, which is their second largest market. So you're seeing competition from BYD, Li, Auto, XPeng, and some of the NIO and some of the other car manufacturers there. So they've had to reduce prices by as much as 10 to 20%. So that helps boost sales. The second major thing was in the US, they had government incentives that appeal to people. You had federal tax credits, of up to $7,500 on specific cars. So that helped to boost sales as well.
Yeah. And to what extent would you attribute some of that to just the high cost of fuel? I mean, fuel prices have been relatively stable in America because the government has access to stocks and inventories over a longer period. But clearly there's a growing shift in more advanced economies away from fossil fuel-based vehicles. And so to what extent do you think some of the numbers we're seeing for electric vehicle sales is driven by the fact that people want cleaner alternatives?
Yeah, I think it's substantial. I think apart from the fact that fuel prices are very volatile, it's the growing shift towards green energy, as you call it. Everybody wants a cleaner environment. And, just looking at that, people just want to, adopt cleaner technologies, not just with vehicles, with, manufacturing technology, all forms of technology. You want cleaner energy going forward. For instance, in Nigeria, the plan is to transition to gas, over the medium term. gas is a cleaner alternative to fossil fuels, to crude oil, actually.
Yeah, so finally, the Bank of England says it wants to force international banks to move from having branches to subsidiaries. First of all, let's even understand the difference between the two. And then it cited the whole issue with some of these big tech banks like Silicon Valley Bank, where there was issue over jurisdictional issues over what it could do in terms of reclaiming assets and liquidating assets on behalf of creditors. What are your thoughts on that move? Will this kind of incentivize more foreign investment in financial services in the UK?
Okay, let me answer the first question. So on the differences, in terms of subsidiary operations versus branches, for branches, the branches are still tied to the parent company. So when it comes to supervisory oversight, the Bank of England has, yes, some level of oversight, but not as much. But for a full subsidiary, like say FBN UK, you have, more intense supervisory oversight by the Bank of England.
Because you're regulated essentially by the Financial Conduct Authority and all the UK regulators.
Exactly.
Yeah.
So that's very important. And like you mentioned, I think the lesson learned from the collapse of Silicon Valley Bank was that the BOE was able to go in and take control of the operations of Silicon Valley Bank UK because that was a subsidiary. If it had been a branch, they wouldn't have been able to do that. They would have had to wait for the regulators of Silicon Valley Bank in the US to do something. Yes.
Yeah. Interesting. Thank you so much for having us on the coming on the show. Actually, we've run out of time. Tunde Abidoye of FBN Quest Merchant Bank, Head of Research. Thank you.
Thank you very much, Rolaka. Thank you.
Thank you.